Welcome, everyone, and thanks so much for joining us for today's webinar. My name is Marianne Hensley. I'm the Vice President of Media Operations for FreightWaves, and welcome to our monthly market update webinar for May. As always, I'm here with FreightWaves Director of Freight Market Intelligence and Sultan of Sonar, Zach Strickland, as well as our lead economist, Anthony Smith. And we would like to thank our sponsors at Open Envoy, which audits every invoice for duplicate billings, excess charges, and supplier fraud, and has audited over $2 billion in spend to date through automation. Start saving time and money with Open Envoy today. Learn more by visiting www.openenvoy.com. And before I turn it over to Zach and Anthony, just a couple of quick housekeeping items. First, if you haven't interacted with our webinar interface before, you can send messages about any issues you might experience through our audience chat function in your console. And as always, we will be taking your live questions for Anthony and Zach, so you can enter those through the Q&A box in your console, and we'll answer as many of those as possible following the presentation. We will also be sending a link to the recording of this webinar in case you'd like to view it on demand or share it with your colleagues. And at this point, I will go ahead and turn it over to Zach to kick off today's discussion. Welcome, Zach.
Thank you, Marianne. So thanks everybody for joining today for our monthly market update webinar. For those of you that don't know who we are, FreightWaves is building a world-class community in freight that uses data and technology to understand, analyze, react, forecast, and de-risk the market. That de-risking is probably one of the more important descriptors in that statement. We have a whole slew of people dedicated to servicing this function. Over 25 market reporters for Economist, including our illustrious Anthony Smith, 7 PhDs, maybe more than that at this point. I can't keep count anymore. And of course, we have a huge media following, 1.2 million unique visitors to our website, 3 million page views, et cetera. So a lot of information that fuels that, of course, is going to be presented here today. One of the things we pride ourselves on is having data, but also the tribal knowledge, the people that have been in the trenches, that have done the pricing and, dispatched the trucks, had to deal with, carrier compliance, brokered freight, et cetera, for several years. So it's not just simply numbers on a page, but also the description of what those numbers mean and how to use them. And that's essentially what we're about to do with the freight market update, and then eventually the economic update here in a few minutes. So I'll get things started with the freight market update, updating everybody on what we're seeing with those, truckload tenders. The outbound tender volume index, the lead off here. This is our demand indicator. This is the, it's indexed to a value of 10,000 that began way back on March 1st, 2018. So anything above that 10,000 level is a percentage above that. Right now we're sitting at about 15.2 K, which again, a lot higher than it was back in March of 2018. So we're seeing roughly 52% more tenders than we did back when this index began. And of course, a lot of that came about right as the pandemic was, I don't want to say getting started, but last year in June, July, we saw one of the largest increases in tender volume, well, the largest increase in tender volume we've ever seen in its short history. So right now we're not seeing anything really changing. We had, February where truckload demand was starting to ease. And then all of a sudden you see that big jump up there in that blue line. That's the current year's tender volume index. That blue line jumped up really quickly the last 2 weeks of February and has stayed relatively elevated throughout that period of time after that winter weather event that we still cannot simply seem to really shake in terms of its impact to the freight market and truckload demand overall. Spot rates shot up around that time as well. A lot of pressure on the freight market. It's really we're still not 100% clear on what caused that outside of, obviously, this has the appearance of something like a natural disaster like Hurricane Harvey had way back in 2017. And the, obviously when capacity gets tighter, people start to scramble and try to get more, they try to get ahead of the curve, a lot like the gas shortage we saw over the last week or so, when people know that things are not going to be necessarily as available. They basically rush to go make sure that they can get whatever capacity they can. And that appears to be the case here in the shipping community, as they've not had a lot of opportunity to have an easy go of finding, whether that be a container or a truck or rail, whatever they're using. They have not had capacity simply just waiting on their doorstep as they haven't had in years past. Over the last almost a year now, we're coming up on that year-long anniversary of, Labor Day here in a few months, when, we kind of hit that capacity ceiling. How much freight can we possibly move? Now, a lot of that infrastructure does appear to be changing moving forward. We don't expect necessarily for the truckload capacity to increase significantly by any means over this next little period, because there's lots of employment issues, but also the production appears to be limited as well, in terms of a lot of the upstream supply chain hasn't been able to hire back employees. They're having commodity shortages and obviously production shortfalls all along the supply chain. So it's self-limiting in a way. And that's why we don't necessarily think that we're going to see the tender volume index start increasing significantly anytime soon, just because it does appear to be ceiling right around that 15.5 thousand index limit. Now, it doesn't mean that it can't increase over time, and I think it may be able to here towards the back half of the year, but again, that will be a slow process that we don't expect to happen over the summer. So looking at our tender rejection index, this is the percentage of those tenders that are getting rejected at this point. So if you want to look at it in terms of compliance, just simply turn it upside down, and roughly about 76% of the tenders are getting accepted. But right now we are sitting around 24% tender rejection rate overall. So 1 in 4 of those loads are getting turned down by carriers, and they can do this for a few reasons. One of those being the fact, and this is going to be one of the big topics of this month's update, that the rates that are sitting in place are not good enough to cover carrier costs, or they have a much better opportunity on the spot market or some other contracted rate. So they'll reject the tender of the lower priced option to take the higher priced option. And then, of course, they don't have a truck in the area, as capacity is obviously limited and has a ceiling. So that's the two main reasons that we see freight rejected. The higher this rejection rate goes, the more spot market activity we see, the higher the spot rates go, and obviously over time, the higher the contracted or long-term rates also go as well. You can see a little bit of a downward angle on the tender rejection index. It is not a sharp angle by any means. It's a slow retraction after peaking once again at the end of March there around Easter. That's Good Friday, but also it coincided with the end of the quarter and end of the month. So it was kind of a perfect storm to create kind of an unnatural secondary peak season, or early season peak, if you will, right around that 27-28% level, something we hadn't seen since Thanksgiving and Christmas. So end of March, it's softened a little bit since then, and it seems like it's going to continue to do this. And one of those big reasons for that, we do think, is probably due to the fact that rate increases are coming into play, which I'll illustrate here in just a second. But looking back at 2018, which is the last time the market was at this level of tightness, we did see a little bit different dynamic in the way that purple line right down there shows that tender rejection rates were increasing at this point in time, and peaked again right around Memorial Day and then around July 4th. So we do think there will be a little bit more pressure on the tender rejection rates going up here in the next week or so as Memorial Day approaches, vacations, et cetera. But that's going to be muted by the fact that some of these contract rate increases are coming into play a lot more often, as well as more predictable volumes. We're not seeing as much of that unnatural, like spiking in demand like we saw over the last month. Savannah is now an established outbound center that carriers have now recognized and, somewhat adjusted to. Los Angeles, once again, still producing a ton of freight, so it's not necessarily that, things have loosened, but things have become a little bit more predictable. And of course, the rates are becoming a little bit more palatable overall. But we do think that capacity will remain tight throughout, obviously, June. But it will be interesting to see if things do start to ease up once again in July. And of course, the next time we talk in mid-June, we'll have a lot better picture of what that actually looks like, because this is definitely unprecedented territory for looking at truckload capacity and this type of pattern. It is a very unusual world that we live in at this point in time, especially in transportation. So as we come out of the pandemic, there's going to be some adjustments, but we do think over time these rejection rates are going to get lower as markets naturally want to move towards an equilibrium. And this one looks to be a slow regression back towards that at the moment. So looking at it broken out into the different modes, this one's interesting because flatbed has been an underperformer in this category. For flatbed tender rejection rates there in the orange, they have been well below van, which is very unusual, historically speaking. Typically, you have reefer and van, or reefer and flatbed competing for that top rejection rate spot. Definitely the more volatile of the three modes. And flatbed has finally come back in line with van and tried to overtake it there in the last few weeks, but hasn't necessarily come back fully just yet. We have a lot of limitations on flatbed. Flatbed, of course, kind of a proxy, as Anthony Smith likes to show you here in some of his slides, for the industrial side of the economy. The industrial side of the economy, it's coming back online at probably a much more healthy rate, but at the same time, those upstream supply chain problems, commodities, lumber prices, et cetera, are keeping things capped at the moment. So that is keeping that sector kind of, I don't want to say subdued, but more subdued than it could be had they had all the means of production available. Reefer rejections, they were coming down a little bit, and now they're back up. They're starting to climb back up again. We broke through that 40% boundary briefly, but now we've ticked back up, and that probably is going to be the case for the next little bit. Produce season, of course, is in full swing on both coasts, down in Florida and as well as in California at this point. So reefer capacity we do not anticipate is going to soften over the next month or two, not in any significant way for that rate. A van, the one that's being very predictable and not changing a lot. The volatility has really been absent from the van market over the last couple of months outside of that bump around Easter. We just haven't seen significant pattern changes. Capacity still extremely tight, just under 24% tender rejection rate for the van side. So it's just not changing that much. So rates are about on par with where they were. We have seen a little bit of a divergence in some of the spot rates, and I'll get to that in just a second on why that is in terms of the direction versus the rejection rates, especially on the van side. One of the big reasons for that is the fact that we're seeing increasing contract rates. This is our van contract initial report based on $80 billion, approaching $100 billion dollars worth of freight spend and freight invoices using 7-day moving average of median rates, valuing the later reports more heavily than the early reports. So it's one of those things where we're trying to measure the rate increases, but also some route guide compliance. Like as you bounce down through route guides, you get increasing rates and deteriorating service. And these rates kind of reflect that. And you can see over the last year, rates have come up significantly. We were down below $2 a mile on average back before June, and now we're getting close to $2.50 a mile on average, and they're still climbing. The trend line is still going up, and as these rates go up, that means that you're going to have increasing levels of compliance. naturally as these rates start to approach market level. And the market level is, of course, whatever the market will pay for those rates. The shippers don't need to bid the rates any higher. What this is going to do, though, is it's going to keep the spot rates elevated because demand isn't falling. You saw the tender volume index. It's staying relatively flat. Tender rejection rates are slowly coming down, but demand is keeping enough pressure on the market to where the spot market is still going to be relatively active. Now, we just saw spot load volumes decline for the first time in a while over the last 7 weeks, and that makes sense. Spot rates are still going up, however, and that's because if you are still operating on the spot market, you're still going to have to bid for capacity against some of these new contracted rates. You're not going to see as many people follow the spot market, but you're now competing with higher price contracted volumes, and that's going to maintain those spot rates at a higher level. And again, that sense of urgency, if you haven't taken a rate increase as a shipper, you're going to really be at the mercy of the spot market at this point. So it is definitely an interesting dynamic to see played out as spot volumes may fall, but the rates, it's not it doesn't look like it's a demand side pressure. If you're looking at spot volumes alone, but if you look at the contracted volumes staying at a high level, you can see exactly why the spot rates are staying elevated and moving higher, because you are now competing against a higher priced competition level with more consistency. The contracted rates, of course, carry more weight with carriers because they're consistent. They have a relationship. So that's why a spot market is going to carry a premium, because it's inconsistent. You're not guaranteeing future volume by any means. And you don't necessarily have a stronger relationship with your carrier. So that's going to be worth a good bit more on the spot market side versus the contracted side. And as these rates still continue to stay elevated, and we don't expect them to move any lower in the near future, especially looking at some of the forward-looking indicators, as Anthony Smith may or may not point out with the Logistics Managers Index, there's not a lot of reason to expect things will change significantly anytime soon on the capacity side. We just don't have enough capacity coming online fast enough. Demand is not shrinking. You see, we're going to get into imports here in just a few minutes and show you that there's just no forward indicator that says demand shrinking and capacity is increasing in the near future on the truckload side, or even on the LTL side for that matter. They're both interconnected. And here's our spot rates. So spot rates showing all three modes showing increases. Again, like I was saying with the contracted rates, they're still competing. They're competing with extremely high contract rates that are still increasing and growing. That's, when you're competing with ongoing relationships and, developing long-term pricing and long-term volumes, you're going to pay a lot more premium on the spot market. That's going to keep that pressure elevated. Of course, flatbed showing the most consistent increase here over the last couple of months. Reefer, you can see bouncing back higher. It's produce season, as I mentioned. And then van showing a little bit more, it's peeking its head up there over the last week or so as those prices go up, as they normally do this time of year, especially approaching Memorial Day weekend. You probably also have a little bit of that seasonality where if you are on the spot market, there's a little bit more sense of urgency that's going to lean you towards that expedited freight tag, where you need some of that freight moved either before or right around the holiday to make sure that there's some sort of availability for your inventory. So that's going to obviously have an impact on the spot market that's not super present on the contracted side as well. So there's another difference of spot versus contracted freight. So looking at, a regional rejection rate, the interesting thing to take away from this is that the Southeast continues to lead the pack in terms of overall rejection rates. We talked about Savannah last month being a big, input for a lot of the freight that's coming in from overseas, as people are looking for other ways to get freight into the country and rebuild their inventories. That's still going on. Demand is still elevated, so they're still playing catch up, and they're trying to get it into the country as quickly as possible and as efficiently as possible. And then the West Coast, tender rejection rates have come down. Now, again, this is probably one of the first places that the increases are going to take place, because of the fact that it has been the largest single point of entry into the United States over the last year. Carriers are they have a lot more difficulty getting across into LA from across the country, East Coast, West Coast balance. There's a lot more density on the East Coast. You have to travel a minimum of 500 to 1,000 miles to get into LA from the nearest large market. And most of those markets are, of course, serviced by Los Angeles and are very backhaul by nature, suffering a capacity surplus versus, the capacity deficiency in Los Angeles. And again, carriers want to go to LA to take advantage of that 1,000-mile average length of haul that you get out there, utilizing your truck for, several days on end at expanded margins is really hard for carriers to pass up, as opposed to going to the, Savannah, where you're going to see a 500 to 600 mile length of haul on average. And it's just, it's a day's transit for most people, whereas you can get, anywhere from 2 to 5 days moving across the country out of LA, where a lot of that freight moves. So it makes a lot of sense, especially since carriers now know that LA is going to have a lot of demand moving forward. Southeast, seeing some produce season pressure, as well as the new volume coming from the ports of Savannah. And we talked about Houston again having, added capacity issues as well last month. Those have faded a little bit, but there's still plenty of freight to move in the Southeast, especially this time of year. Southern tier of the country tends to get active in the summer and by nature in general, as the Northeast kind of tends a little bit. The Northeast tends to have its most active season around the holidays. Southeast tends to have its most active time of year right around now. So this is not necessarily out of expectation. So moving on to the maritime side, this is the freight potential in the United States. So imports have been a big reason for the freight boom, if not obviously the majority of the explanation. And Anthony will probably give you some highlights on, some of the commodities in different sectors in terms of retail sales and whatnot, of why this is happening, and it continues to happen. A lot of the retailers, e-commerce, et cetera, still growing year over year. They can't get freight into the country fast enough. You can see all the way back, starting in August, huge amount of import volume. And this is, of course, BOLs that are clearing customs each week, that we're tracking through each port in the United States. These are maritime orders coming in from places like China, Taiwan, Vietnam, Germany, Italy, India, name it. This is where most of this freight is coming from. And you can see it's actually growing a little bit. And we did not have Chinese New Year show up in any of our data. We had a little bit of a lull there a few months ago, back in March, that really you could allocate some of that to a little bit of Chinese New Year impact, but year over year, it's almost indiscernible. You can't see any we normally see a huge drop in activity around that period of time. This year, not at all. And it continues to grow, and this is concerning given the fact that we haven't even arrived at what is traditionally peak season for importers. So this may only get worse, over the next couple of months. Henry Byers, market expert on maritime side, does anticipate a pretty rough go of it into July and August on the import side. Looking at our market share. So this is basically, the percent of orders or shipments coming in, the same data, that customs data. We're seeing a little bit of a retraction in the ports of Los Angeles in terms of overall market share. It doesn't mean their volumes are dropping. It just means their volumes haven't grown as much as some of the other markets out there. So Port of Savannah, I have this sorted month over month, so it did see a little bit of a retraction month over month. It has eased a little bit. New York, New Jersey, growing. Once again, East Coast, growing in relation to the West Coast ports at this point. A little bit of degradation in terms of overall market share, on the West Coast port side, Long Beach and Los Angeles. But, as I mentioned earlier, we're seeing a lot more freight coming in through the secondary ports than we have in the past, and that's creating some imbalances in capacity. But overall, volume's still very, very elevated, like you saw on the previous chart. Customs imports still up overall. This is just showing you who's growing at a faster rate, if you will. And this is, one of the ports I wanted to highlight is the Port of Oakland. The Port of Oakland, this is one that Henry Byers specifically talks about here in the last few weeks, with large growth coming on in the Port of Oakland, and you can see the tender volume index there. We had this huge spike in import volume in March, Port of Oakland. See those three peaks there. It looks like the Grand Tetons. And then all of a sudden, tender volumes start to increase as well out of what is traditionally a backhaul market in Northern California. San Francisco, not necessarily, it tends to suffer from oversupply versus, too much demand. And that has been growing, and that looks like that may continue as, we see this shifting dynamic, which may be a good strategy for shippers because, like I said, this is an oversupplied area of the country. And it is naturally going to have a little bit more opportunity as carriers figure this out. Instead of having to drive south to LA, they can just catch some freight and start heading east directly, that'll be an interesting one to see how that plays out. And then moving forward into the rates. So these are the maritime rates. This, again, just illustrates how capacity continues to be an issue, especially on the maritime side. We thought things were going to level out. Rates are jumping back higher again. We can see it on the, the customs imports. They're still clogging the ports. There's several ships at anchor still. Demand isn't going anywhere anytime soon on the maritime side. The two recent jumps in rates here, very reflective of both the East and West Coast. You see the orange line down there? That is the difference in the FreightWaves index rate. These are spot rates for 40-foot containers coming across from China to North America's East and West Coast. This is obviously our largest maritime trade partner. They also make stops, along the way in some of the other Asian countries, but this to me tells me that this summer is going to be wild and active. Even as tender rejection rates kind of fall a little bit, demand is still going to remain extremely high. Capacity is going to be at a premium, more than likely, and you see that jump going to the East Coast versus the West Coast. That East Coast strategy may not be as effective as it was in the past, especially as those diverge. As you see that Panama spread rate down there in the orange line increase to its highest level in a few months here the last bit. So you're not necessarily saving as much money, but I still think there's plenty of discount there to cover, sending it on a ship if you can manage the transit times going to the East Coast. It's only, it's less than $2,000. It's going to cost you a lot more than that going via truckload, going from LA to, the population centers on the East Coast. Looking at the IOTI, this is our inbound TEU volume index. So this is an index that basically shows you the percent change in booking data. So when people are booking more TEUs that are and that's their estimated times of departure that x-axis is measuring, that is where we're seeing it continue to grow. So again, another data point that suggests demand is not softening. Shippers are still requesting more TEUs than they ever have before. They don't always get accepted. It's kind of like our tender volume index. It includes total tenders. It is not just accepted volumes, but the fact that it continues to grow is an indication that demand is not softening by any means on the maritime side, and therefore will probably bleed into the surface transportation sector in the coming weeks and months. This has a lead time of about 12 to 21 days on average if you are talking about a normal year. Right now we're looking at roughly 3 to 6 weeks before it gets into the United States at this point, based on the congestion at all the ports, the container shortages, et cetera, that continue to plague the space. So things are still going to get even more. There's even more demand coming through the system. Whether or not we can handle it is going to be the big question. So This is spread. This is the IOTI, basically, showing the growth in individual ports. We've got Long Beach there in the blue. It continues to be supported by strong demand. Oakland, of course, we talked about that one getting a lot stronger. New York, New Jersey, Savannah, all up there. These all are showing no signs of slowing. Some of them have grown a little bit faster than others. Long Beach, of course, has a lot more volume to start with, so that percent change isn't necessarily as it's much more significant, I should say, than some of the others. So when we're talking about increasing demand through all our major ports, it's going to spill over into some of the smaller ones as well, like I illustrated with the Port of Oakland. So everybody's going to have to be on point over the next couple of months if they want to get this freight into the country and moving more thoroughly. And of course, the rail side of things, intermodal volumes also reflecting increasing demand. These is, carloads of intermodal containers moving across the United States. We're up year over year, 2 year, 3 year, et cetera. You can see the 2020, we're well over 2020 by this point, but we've broken through 2019 and 2018 as well. Intermodal container volumes still elevated. We're looking at peak season volumes right now on the intermodal side. So it's going to be a tight market for the foreseeable future, it looks like. And those rate increases seem to be, making a dent in the overall contracted freight side. The spot market is still going to be like the wild, wild west of the freight market. As things, people are going to be gunning for capacity. Rate increase strategies are probably the best go of it right now in terms of purchasing compliance and making sure that you're not one of the ones that's paying 30 to 40% more on the spot market. And of course, your capacity is, moving with the wind out there, and there's no guarantees. So freight market's still tight. And with that, I will hand things over to Anthony Smith to give you all the economic side of things.
Thank you, Zach Strickland. Insightful as always, the Sultan of Sonar. So as Zach mentioned, going to give you an economic update overview of what's happening in the macroeconomy and also what it means for freight. So jumping into it real quick, we have our first chart here looking at consumer conditions, and what we've seen for initial jobless claims, or really a measurement of what's happening at the consumer level, is that there has been consistent drops for initial jobs claims on a week-to-week basis. So this number is put out every Thursday morning, and it shows what's going on how many individuals are filing for initial jobless claims for the first time. And we've seen some consistent lows for the pandemic. And so this is something that's meaningful. This is something that we see should be a meaningful sign for where we're moving in the economy. So earlier on in the year and much of last year, we've looked at this number and it kind of hovered around that 600,000 to 700,000 mark. It was no notable changes. It just kind of stayed there. I mean, it was a far cry from this over 6 million individuals that claimed at the peak of the pandemic. But it's still a bit of ways away from that 200,000 mark where it kind of hovered right before the pandemic. So there's that to take in consideration. When we're looking at these jobs, though, not all jobs are going to be expected to be the same jobs that people left, but there are more and more openings coming up on a monthly basis, it seems like now. And so that's going to be another good indicator for where consumers are within the economy. So this is another positive sign for overall consumer activity. And of course, as much as Zach hates it when I mention consumer confidence, but an employed consumer is usually a confident consumer. A confident consumer is going to spend a little bit more discretionary spending, and it's going to lead to more freight volumes and retail activity and purchasing power. So we're looking at that. Those employment conditions are going to be beneficial for the overall macroeconomy. The other thing to take into note here, of course, within all of that, we have to think about what's going to happen with those individuals that are receiving initial jobs claims benefits, because those bonus benefits are still in place right now. We're seeing that those that are in place are receiving an additional $300 on a weekly basis, and in addition to what they're already getting on top of their initial unemployment benefits. And so we're seeing that some of that might be serving as somewhat of an incentive for individuals to not really kind of return to the workplace. And I mean, of course, it's going to be on the lower, income levels where we can see a comparable pay for staying within the job market or kind of leaving the job market. But that's going to be a bit of a pressure point for many industries that might have to compete with those folks that are going to be maybe considering, hey, I can make just about as much or maybe a little bit more, a little bit less on these unemployment benefits for a couple more months. So maybe I'm not going to rush back into the workplace just yet. I think that's probably going to be a little bit more reflected upon in the unemployment rate, which ticked back up to 6.1% from 6% in the previous month's report. So that's going to be an area to watch closely. But again, we're looking at these initial jobs claims is pointing into consistent decreases on those claims coming in. And so that's a good sign and a positive aspect for the jobs market as we're kind of moving throughout the mid part of 2021. That, of course, is going to translate into retail sales. And so what we saw in retail sales was really impressive. So what we have here in the green line is our monthly our monthly component for retail sales put together by the U.S. Census Bureau. This is going to take into account non-store retailers. So we're primarily looking at e-commerce. And the blue line we have here are dry van tender volume index, looking at overall volumes of freight moving throughout the U.S. And what we can see is that the two usually have a pretty nice relationship. When one is elevated, the other one is sure to follow. So what we can see within that green line for that non-store retailers, the aspect of e-commerce and overall economic activity, I guess on that online area, what we're looking at is that this was impressive. It was flat month to month. A lot of outlets are reporting that it kind of came below expectations. But when you think about what happened in the month before, in March, we had these stimulus packages that were just put out, the third round of stimulus. And so to match that kind of shows that there is some credence to more people getting back into the workplace, more confident spending, and increased demand throughout the economy. The other big thing that has kind of been a talking point throughout the economy, or really kind of throughout the country, I should say, especially on many headlines, is inflation. And I mean, this is something that we've been talking about for a while, especially on the manufacturing side, which we're going to get into here shortly, with those increased prices at the manufacturing level. But what we're seeing is, of course, that there is a lot more, I would say the recovery within the U.S. has been pretty aggressive, especially with vaccine efforts, reopening of many sectors and segments, things like that. That's going to lead to more, that's going to lead to a little bit more activity on a lot of segments, not just e-commerce, but we're looking at back into brick and mortars. Although that is moving on a downward trajectory overall, it's not going to recover anytime soon, or ever likely. But that's going to be one of the areas where we're going to see that there's going to be increased demand. And so we're looking at where we're getting these goods, of course, overseas, import activity, things like that. A lot of other countries aren't going to be able to produce those goods at that same rate or at that same level. So we're really can expect to see is that we're going to have a lot more increasing on the consumption than what we can see around the actual amount that's going to be able to be produced overseas. And so that's going to lead into some scarcity for final goods, in addition to that scarcity that's happening at upstream within manufacturing. So just as mentioned, we're going to talk about some of that manufacturing right now. What we have here is the ISM, the Institute for Supply Management, Purchasing Managers Index, the PMI. And so what we can see here in the orange line, the PMI, which is going to represent anything over 50 is indicative of expansion, while anything below 50 is indicative of contraction within the segment, is that there is a lot of expansion still happening within manufacturing. Although there was a slight tick down, that is not indicative of overall slowing down within manufacturing, but it's just expanding at a slower rate. So what we're seeing within manufacturing is that there is indeed backlogs building, and there are new orders still coming in and expanding on month-to-month basis right now. One of the things that we are seeing is that there are going to be employment issues, and this is going to be one of those areas that we're talking about where the jobs that people were leaving may not be the same jobs that they're going to be coming back to, especially within manufacturing. I mean, we're looking at people that maybe were operating a little bit more on the manual side. They might have to come back into a factory or manufacturing workspace where, they were having to adjust to the pandemic conditions and maybe implement a little bit more technology in the workplace. Maybe there's going to have to be a little bit more training and kind of getting up to speed on maybe some coding aspects and things like that within the workplace. And so there's going to be a little bit of a friction there. We're looking at employees coming back into the workplace. There might be some training that's going to be needed in certain segments. But anyway, when we're looking at the manufacturing segment, of course, there's that aspect that I've always been talking about for the past few months now, and that's going to come in the form of prices. And what we have here in the ISM PMI breakout is the prices component, which is right at that 89, I can't believe I'm saying this, but 89.6 percentage points. And so this is within 1 percentage point of the all-time high for the manufacturing prices component index. And so this is increasing at a faster rate and has been increasing for the past 11 months within the same trend. And so nearly a year that these prices have been increasing, and nearly a year that these manufacturers have been taking those increases on as we've been kind of navigating COVID-19. And so a lot of this, of course, as you all know, are going to be brought on by the commodity shortages across the board, which is we've always kind of been a little bit not skeptical of it actually happening, but some of the downstream impacts. And we've been kind of talking to this point for some time, and we are seeing it in real time now, of course, not just with lumber, but all types of commodities across the board. And we're looking at, steel, we're looking at any kind of food like soybean products, plastics, resins, rubber, any kind of materials like that. Looking at corrugated boxes, of course. We just, of course, had diesel or gasoline in the price in the headlines not too long ago, along with crude oil, things like that. We're looking at semiconductors. That's going to be another one that's going to be hitting downstream, not just now, but kind of for some time to come, weeks or maybe even months to come. So those upstream price increases are going to have some downstream constraints, and that's happening right now, and that's what we're seeing, and that's likely going to be a thing for a bit more time to come. So we're looking at the overall landscape of what's happening within the U.S. economy. This kind of all ties it together. I mean, I've gotten a lot of questions around inflation, and of course, there are many components to inflation. I mean, the biggest thing that a lot of people were talking about was just the money supply, but the money supply is only one component. I mean, we have to also look at the velocity of money. I mean, how quickly money is exchanging hands throughout the economy, and that's going to start to pick up. I mean, we do have consumers that are going to be sitting on a lot of savings right now. They haven't spent some of their stimulus packages that they received or some of those bonus benefits that they received. A lot of people are still sitting on some of those things. And so low velocity of money is going to diminish some of the impacts of inflation. But we are seeing that those more confident consumers are going to be spending a little bit more discretionally. And so when we're seeing that, there's also going to be some impacts around inflation when we're coming to overall economic production. We're seeing more production happening on economic front, especially when we look at manufacturing. It's just going to be constrained by those manufacturing prices, but that's going to be another upward pressure for that overall inflationary sector or component when we're looking at those slowdowns, those headwinds, when the lack of commodities, the lack of adequate employment to kind of take on the manufacturing of those goods. And so all that's going to play into the upper pressure that is building right now for inflation. The other thing that's really going to be kind of really hitting it, of course, is going to be the supply. And we kind of talked about that when we're looking at more and more consumers increasing their consumption of goods throughout the economy. Moving into the next one, we have, of course, housing and construction. Can't finish off this webinar without talking about housing and construction. And what we have here is housing starts increasing on a year-over-year basis, of course. I think we're looking at year-over-year comparisons, especially for housing. They're going to look strange for some time, especially comparing where we were this time last year. But when we're looking on a month-to-month basis, we saw a downward shift. And so that ease does not come as too much of a surprise, especially when we saw a little bit of cooling down in our flatbed outbound tender rejection index, which is in this orange line here. But that's not really indicative of a slowdown in demand or ease in demand. This is going to be, of course, around those lumber prices that are building up right now. We're seeing that constant increase in building products, and those headwinds are going to really be impacting what's happening right now within new home builds, or maybe even some home renovations right now. So those increases are really going to take a toll on the amount of homes that are going to be able to be built. When we're looking at the permit activity, indicative of future activity for housing overall, we're seeing that that's increasing. But the overall shortage for new homes and existing homes, that lack of inventory, is definitely going to keep these pricing pressures up across the board, as we're seeing that demand not really subside anywhere. So when we're looking at, of course, these new home starts, housing starts, things like that, that's not going to just end at the flatbed capacity, but it's also going to extend into downstream. We're looking at retail sales for appliances and furniture and things like that. So that's also going to be the thing to kind of take into account. We're looking at what's happening overall within the economy and the freight market. So with that, I think we have a little bit of time here for some Q&A. And I'll hand it back over to Mary Ann here in just a second. But quick summary, as you can see right here, we have rate increases that are having impact on compliance. We have imports, which have been elevated and seem to remain elevated, are going to remain elevated for some time to come. Employment conditions are improving, but still have some resistant points that we're going to have to really kind of take into consideration as we move throughout the mid part of 2021. Retail sales surprisingly maintain momentum in the latest retail sales report from the U.S. Census Bureau, especially when we take into account that March had a stimulus boost compared to that lack of stimulus that we had in this last month. And we're kind of seeing those increased employment numbers really kind of probably taking hold there. We're also seeing that manufacturing constraints are still alive and well, especially with commodity shortages. And with that, I will hand it back over to Mary Ann, and I think she's going to lead it into Q&A. Thank you so much.
All right. Thank you, guys. Great insights as always. And at this point, we will take some time for questions from those of you in the audience. If you've not already sent those, you can do so through the Q&A tab in your control panel. And we will start out with a few for you, Zach, because I think that might be the fastest we have ever gotten through this presentation. And I'm sure Anthony could use a breather. First question for you, Zach. Is the index number normalized for the same percentage of electronic tenders that you have access to relative to the total freight market? Or is it up 52% because of more tenders going through the electronic tendering process?
So there is a little bit normalizing going on in there, and that is more focused on around removing some of the anomalies, like when you see some sort of statistical deviation at a market level over total tenders. But yeah, there are more tenders. Like, we wanted to count more tenders over time. Of course, as the index gains history, we have thought about normalizing the tenders at a certain level, but in the early stages of the index, it's only 3 years old. We're definitely going to keep track of the total tenders themselves, and it does have a little bit of check points in there to make sure that we're not necessarily seeing some sort of anomalous growth that doesment make a lot of sense in terms of measuring the total capacity. Because it's a demand side indicator. And that's the thing to take away from the OTVI, is that we're trying to see changes in demand. We're not necessarily overly concerned about total truckload volumes at this point, which we have discussed in the past, and we are still working on making one of those indexes based on the tenders. But that's requiring a little bit more work on the back end. So think about this more of a demand indicator, that you're looking for changes in overall market demand. So anytime it jumps up or moves down, it means that demand is either softening or easing or increasing.
All right, thank you. And then kind of a related question, maybe for some clarification here. The increase in OTVI, or outbound tender volume index, is not at all related to bringing new sources of tenders. Is that correct? Or previously not captured moves that are now being captured by one of the existing sources? So they say it does look to be indicative of higher volumes. Would you agree with that?
Yeah. Looking at the back end, there are more volumes, and it's roughly the equivalent of about 15 to 20% more volume versus the 52% that you see there. Just to give you a little bit of, you can do that math, taking the tender rejection rate out of it, or the rejected tenders out of it, and calculating the accepted tenders.
All right, perfect. And next one, are there any indicators that final mile delivery delays are slowing consumer purchasing? And if not, how much pressure is supply chain delay putting on spot rates?
Yeah, we don't have any final mile specific data in terms of service for sure. But yeah, I think it's pretty indicative. Like the tender rejection rate is probably correlated quite highly with service and compliance in general. In other modes, especially the truckloads, especially the stuff that's happening today, on the e-commerce growth side. But I don't have anything specific we don't have anything specific on final mile itself.
All right, got it. Next question. We've seen an uptick in mini bids because of tender rejection rates and new lanes materializing. Are you seeing the same?
Anecdotally, yes. We've talked to a lot of people about mini bids over the last bit. We don't have any way of knowing whether or not those contract rates that you saw in that VCRPM index are mini bids or not. We just know that they're going up. So that's, we could see a correction that happens prior to a 12-month cycle. If those mini bids expire and go into some sort of regression here in the last few months of the year, but it's hard for me to imagine that happening. Mini bids work only if you guess the cycle correctly. If you don't guess the cycle correctly, as I haven't a few times now, then you're setting yourself up for just another, excess work to, not necessarily solve your problem long term. So you're really trying to guess. You don't want rates to increase 3 months down the road when the bid expires, which if you're going to put out a mini bid now for the 3-month cycle, yeah, that's a tough call on your end. But yeah, they are definitely one of those. But a lot of people are looking at new, more dynamic pricing in general to see if they can't, I don't know if that's necessarily optimal for cost savings, but it's definitely optimal for compliance.
All right, great. And next one, I see load volumes are still high, spot rates are still climbing, new contracts are up. What about capacity?
So capacity is not, for us, we look at tender rejection rates as kind of that end result, that end game for capacity and basically supply, demand curve. The end result is that tender rejection rate or tender acceptance rate, whichever way you want to look at it. And with that not really coming down significantly, that's an indication that really capacity isn't growing significantly. Back in 2018, when we saw a bunch of those truck orders come due and they were getting delivered, which should theoretically start to happen en masse here in the next probably 2 to 3 months, given if the supply chain itself for the OEMs was operating effectively. But they're on backlog and back order like everybody else. So, I think in the last webinar, I highlighted the Class 8 orders along with the employment levels for the trucking industry. And it's, the employment side of things is not coming back either. So you can't just order a truck and expect there's a driver sitting there waiting on it. And that's going to be a big thing. So I think we'll see demand start to slide probably before we see any kind of real increase in the capacity side, which I think will inevitably happen, especially later in the year. I think capacity will start to grow more significantly. So keeping an eye on those employment levels and, especially as those truck orders start to come due in September, October.
All right. And next question, with cost per container up 200 to 300% and trade tensions with China, do you think we'll start seeing manufacturing moving back to the U.S., Mexico, and Canada at an escalating rate?
We haven't seen it so far. Most people have gone back to the tried and true method of, going to Vietnam, which isn't going to degrade the reliance on China that much. They just don't have the infrastructure. So we haven't really seen any significant growth in Canada or Mexico just yet. Those places may have a little bit more barrier to entry as the infrastructure just isn't built out as well there as it is over, in Asia. And of course, they don't necessarily have the population support that the Asian countries have. So it's, in theory, it sounds like a great plan, but it's also, in terms of looking at the data, it's not materializing just yet.
All right, great. And then one for Anthony. If factories are facing material shortages and worker shortages, how is manufacturing on an upward trend?
Sure. So when we're looking at what's going on within manufacturing, the shortages in materials and not really having adequate employment forces on the labor side isn't going to be a factor of demand. So demand is still there. And so we can say that there's going to be an increase in manufacturing outlook or manufacturing activity, even though there are material shortages. So those would be two different equations that we're looking at. So if we're going to see that there's going to be increased pricing for these products, manufacturers are going to have to pay those increased prices in the face of these new orders building up. And those new orders that aren't going to be placed are going to be pushed in the backlog of orders. And so we're seeing an increase in backlog of orders. We're seeing an increase in new orders coming up. And so that increased business-to-business activity is also going to be pushed into eventual production. Whether or not that production comes to fruition now or a little bit later is not going to really be a factor of whether or not we have an adequate supply or it's not going to be a one-to-one for actual demand. So the demand is there, but whether or not we see that now or a little bit later isn't going to really be an impact of whether or not demand is going to be, stable or not.
All right. And we've got just a couple more here that I think we can get to. Is OTR driver pay continuing to increase? And is finding qualified drivers the main issue with capacity?
Yeah, the reports are coming in that wages are still going up, and maybe a lot of those wages are coming up in some of the smaller carriers now. The larger carriers took increases earlier in the year, trying to lure more people into that side of the work. I don't think we're necessarily going to see a huge change in that growth until later in the year. However, like I mentioned, the employment, for whatever reason, Anthony's probably better to talk about it than me, is still, the lower wage jobs relative and the blue collar jobs are just not coming back very strong. We're seeing it not just in trucking, but in just about every industry. The stimulus bill, albeit needed, probably is keeping a lot of those people, on the sidelines, or a lot of them have also transitioned into different areas of work. So, like drivers, for instance, a lot of the competition has gone to construction. They don't have to be over the road. They found other opportunities that are keeping them sidelined for longer. So those industries that, kind of shut down over the last bit, and, trucking really didn't shut down, but for a period of a few months. But even in that short period of time, we didn't, a lot of people didn't commit to the trucking sector coming back, so they didn't rehire as quickly as probably they should have. These people went out and got other work and found new career paths within those industries that were still going. So there's a few things going on here that are going to limit this. Again, barriers to entry with the FMCSA, Drug and Alcohol Clearinghouse. We say it time and time again. Yeah, it may sound like a taboo thing to mention, but it's reality. That has had at least a 1% removal effect on the driver pool availability that's happening. So that's not going away anytime soon. That's why I think it's going to be more of a demand side easing than it will be a capacity side increase.
All right, great. And then we will take time for one more here. How should we be thinking about 2022 in terms of both ocean and van rates?
Yeah, I think you're going to see rates stay elevated. I mean, this is going to take a while for any kind of, I mean, if you're getting your contract now, the mini bid may work out for you. I'm not real sure. But think about any of these rates that are going into play. They still, the gross majority of these rates have a 12-month cycle. The ocean has a little bit different process. It's going to take some time for those ocean rates to start to come back down. The way that I look at it, I look at the trend line. How long did it take to get here? Assume about the same amount of time for it to go back. I don't see the demand easing off overnight for either mode. It's going to take a period of time for that to start to contract, and therefore those rates are going to be slow, to have any kind of easing on them as well. So I would say plan on 2022 having, elevated rates, and it'll be a lot like 2019 in the way that there were a lot of rates that were above market level because they were set on 2018 premise. And just like this year, we saw a lot of 2019 rates ineffective in a 2020 environment. So it's that pendulum swinging back and forth, and those cycles last for at least 12 months in general.
All right, perfect. Well, everyone, thank you so much. That is all of the time that we have for today. So we appreciate all of you for taking the time to listen in and for your great questions, to our partners at Open Envoy for bringing you today's webinar, and of course, to Zach and Anthony for sharing your insights with us today. As I mentioned earlier, we will be sending out a link to the recording of this webinar tomorrow via the email that you used to register, in case you would like to view it on demand or share it with your colleagues. We appreciate you spending this hour with us and hope you'll join us again next month.